carry on the conversation now. Field Point Private Chief Market Strategist Cameron Dawson joining us. Cameron, every earnings call that I'm listening to, every report that I'm reading is, particularly from the industrials, about two things. What is happening on the input story, and that is basically kind of labor, energy, supply chains on one side, and just super strong demand on the other. Let's talk about the input story for a while. Cameron, do you think that these companies can continue to pass on the higher costs that they're seeing at the moment? What would normally happen when we start to see rising costs? How would they deal with it?
So there is no sign that these companies are having trouble about passing prices on to customers. The companies that have reported thus far in earnings season are putting up some pretty incredible pricing numbers and even saying that pricing into 2022 will be really strong. Take a company like J.B. Hunt, who's saying that they think that they can get high single digits to low double digit price increases for intermodal next year. So at this point, there's no sign that those customers are pushing back on higher prices. But what we need to look for is in the orders numbers to see if we're reaching that pain point where customers are saying enough is enough. At this point in orders, we're not seeing any evidence that customers are pulling back on spending, but there was something very interesting that came out from the Philadelphia Fed Manufacturing Survey yesterday. So that orders number still remains very robust and near all-time highs. But if you look at the survey question about orders in the next 6 months, that number actually plunged this past month. So it's not enough to call a trend or to say that this manufacturing cycle is over, but we really do need to watch to see if there's any more signs that orders are starting to slow down.
What is that breaking point in terms of prices? As you said, if these companies have the pricing power, when do you think we get to that point when consumers start to push back and say maybe not?
So it depends who you are and what kind of margins you have. We're not seeing in the US signs again that we've reached that breaking point, but in the UK, we are. If you are a low gross margin producer, or if you are somebody that doesn't add a lot of value into what you're manufacturing, what you're seeing is that energy prices are enough to cause you to curtail production. So think of things like fertilizer, glass manufacturing, aluminum smelting. We're seeing that kind of production get cut. But if you are an industrial company in the US, you have really high gross margins, and let's say you play in niche areas where you have really strong pricing power, in those areas, you're not having trouble pushing prices through. Now, you are exactly correct that we need to watch the consumer very closely, because the consumer really is the end of the line for price increases. They have no one else to pass that price increase onto. So if we start seeing fraying in consumer spending, then that could be a sign that things are slowing down overall. The interesting thing there is that we've all been talking about the University of Michigan Consumer Confidence Survey and how consumers are saying it's no longer a good time to make big purchases. But we're not seeing it show up in a big hit to retail sales yet. So It's something that we have to watch, but we're not seeing it yet in the sales.
In terms of what would normally happen at this point, you would normally see, so I spend a lot of my time talking about airplanes. You would normally see if energy prices start to go up or input prices go up, the companies within the aviation sector would look for more efficient ways of doing things. They'd buy more efficient airplanes. They'd figure out how to manage their fuel costs a little bit better. To what extent is this time going to be different?
So exactly. We usually do see this trade up into better efficiency type of equipment. And we also usually see a big boom in energy capex related to higher oil and gas prices. But what could be different this time is that those industrial companies that typically benefit from better fuel efficiency, better kinds of efficiency things, if their customers can't get their hands on to order that higher fuel economy truck, it really doesn't make much of a difference if you can't deliver it. The other part of it is that energy companies really aren't spending on capex like they have in prior times where we've seen big spikes in oil prices. And there's a few reasons for that. One, we know that there's ESG mandates that are causing companies to divert investments from fossil fuels into more green investments. But the really important one is that equity investors in those energy companies are going to the energy companies and saying, hey, we don't want you to spend as much in capex. We want you to live inside your cash flows, essentially don't spend more than you're making, and we want you to take all that cash that you would normally generate and give it back to us. So companies are now saying, hey, instead of increasing capex to get benefit from higher prices, we're actually going to appease our equity shareholders, because if we don't, we could get our multiple hit. So we're not seeing that same kind of increase in capex, which would normally be good for industrial companies, but likely is going to be more muted this cycle.
Is it going to be good for investors, though, as we're thinking about a return of cash to investors versus investing in the company?
I think in a sense, yes, because you won't see, hopefully, the same kind of boom and bust swings where you've got really profligate spending at the peak of a cycle. So hopefully we'll see a little bit more discipline through these cycles on the investment spending. But there's something really important to note from these energy companies, which is the reality that rig count since the peak in 2014 when we had the frac boom, it was right before the industrial recession. Today's rig count is 75% lower than it was in 2014. But the crude oil output is actually 30% higher in the US than it was in 2014, which means that we're generating 30% more crude with 75% fewer rigs. So in your question about, is this good for investors? In a way it is yes, because we're proving that we can do more with less.
Cameron Dawson, Field Point Private Chief Market Strategist, really appreciate your time and your thoughts there. Thank you.